Join us, everyone. Today I'm happy to introduce Natalie Pace, the co-creator of Earth Gratitude Project and author of the Amazon bestsellers Power of 8 Billion, It's Up to Us, the ABCs of Money, 6th edition, and more. He has been ranked as a number one stock picker above 835 A-list pundits by independent tracking agencies, Tips Traders. Ms. Pace's easy as pie chart nest egg strategies are enthusiastically recommended by Nobel Prize-winning economist Gary S. Becker, former TD Ameritrade chairman and CEO Joe Magua, and over 120,000 people who have transformed their lives and relationships with investing and money as a result of attending her retreats and reading her books. And with that, Natalie, the floor is yours.
Thank you so much. I'm really happy to be here, everyone. Um, so let's jump right in. I think that, tracking the results so far this year, what we've noticed is that safe havens have performed even better than stocks. So, of course, you've been hearing about gold and you've been hearing about crypto at all-time highs, but you probably haven't heard that silver is actually the silent super performer, and copper has been on fire as well. So let's jump into some of the results, and better yet, how you can invest in these in a proper, age-appropriate, properly diversified plan, but also without capital gains. And this is pretty key, especially for cryptophiles, because a couple of years ago, it was pretty hard to avoid capital gains taxes if you were going to capture some gains. It's pretty easy now, but you have to know how to do it. So we'll talk about that as well. So our Ethereum ETF actually tripled in just 4 months. We'll talk a little bit more about that. Bitcoin was our 2024 investment of the year. Obviously, it's better to buy low. When we listed it, it was a lot lower than it is today. It's more than doubled since that time. So, really, well, almost doubled since that time. So it's really important to understand that if you are buying right now, you might be chasing gains. You're definitely buying high, hoping to sell higher. Now, is there a way that you can do that if you missed out so far, rather than waiting for the crash, which of course market timing never works? And we will talk about strategies to get invested if you are not already, as well as should you be capturing gains now? We'll talk about that as well. So here's the actual scorecard of crypto, copper, silver, gold, Magnificent Seven, which is largely communication services and information technology, as well as utilities, financials, etc. So what you'll see here is that a lot of the things that are traditionally going to be in our value funds are the worst performers, and the growth has been the best performer. Now, in a properly diversified plan, you would have both value and growth. You'd have medium, small, and large. We actually add in four hots so that you can get crypto, you can get copper, you can get Bitcoin, you can get Magnificent Seven if you want a little extra of that, and whatever else that you think is super hot in that particular moment. But it's really important to realize that these value funds in the United States, first of all, not only are they really underperforming the rest of the industries. So if you're just doing a Dow Jones Industrial Average index fund, and a lot of times that might be one of the choices in our 401k, that's going to be far underperforming. And if it has a lot of bonds in it, if it's like a target date retirement fund, it might have actually lost money over the last 5 years. So just so you know, what we've been doing in our financial freedom retreats, and I also highlight this in my books, is we have been using value replacement funds. And there are other countries with a much lower debt to GDP, a much higher growth rate, and oftentimes they're offering up to double the income as well. So we'll talk a little bit more about that as we move along. So silver was really the silent performer. Now, will these precious metals continue to soar? What could ruin the party? What is your best strategy? And how do you mitigate capital gains, right? Because if you're purchasing coins, chances are that's not in a retirement account. So you may have to pay capital gains if you want to capture gains. Now, I know that there are a lot of urban legends out there that gold and silver never go down in value, but anybody who's actually invested in them knows that they can. So 2011 was the prior high, and then they lost about 40% in 2012 going forward. That lasted for about a decade. So you can't really put everything you've got in precious metals. Crypto has crypto winters. And that's why we use an age appropriate, properly diversified plan and use our hot slices for these precious metals. Now, better yet, if you can put them in your retirement account, and that's going to obviously require that you either invest in, if you're doing gold or silver, you can do the actual companies that mine it, or you could do a trust that follows the price of it. So those are two ways that you can both mitigate the capital gains, but also, as importantly, have a strategy for capturing gains at the high that's not all or nothing, not waiting for the crash or waiting for the exact high, because you're never going to hit either one of those right spot on. But if you have a strategy such as our pie chart strategy that's always age appropriate, always properly diversified, you rebalance it once, twice, or three times a year. When you have one slice of gold that's become three slices, it's prompting you to sell high and trim it back to one. That way, if we do hit a weakness point, then you can buy more at a lower price instead of just watching your returns go to nothing again and then waiting for them to come back. So, yeah, that's an important strategy. Again, I'll show you a pie chart in just a moment on that. But, and I'll also talk a little bit more about how to fill up slices if you haven't already done it. Now, with me, what I do is if I have an employer-sponsored plan, then I'm going to contribute up to whatever the employer matches in that employer-sponsored plan. Now, a lot of people say, oh, I want it pre-tax dollars. Well, why not have both? Have the free money that your employer gets you, have your own Roth IRA, and you can put your HOTS in the Roth, because chances are you cannot invest in crypto or gold or silver in your employer sponsored plan. So I put my HOTS in my Roth. And by the way, in that one, at the end of the day, I will not have to pay income taxes on it either. No capital gains or income taxes. Reportedly, a billionaire Peter Thiel has 5 billion in his Roth IRA. He didn't pay cap gains and he's not going to pay income taxes. So that's a good strategy, is to have more than one investment account, your employer sponsored one, your own Roth IRA or traditional IRA or SEP IRA. Also, for those of you who do not know about it, health savings accounts can be a great tool. It's the best long-term healthcare strategy. It can provide a tax credit. You can invest it, and it can also save you thousands in healthcare premiums. So that's something I think everybody should be a little more aware of. We're not talking about it much today, but I did want to throw that in. So, you're going to want to stop making the tax man rich with secrets of the 1% wealth strategies. Now, I just talked about that, right? So instead of thinking about crypto in a wallet, why not in your Roth IRA? Gold and silver coins, you're going to also, oftentimes you have to pay a premium on them. So a lot of times it's not the exact ounce that it's trading for. They'll call it a semi-numismatic coin, a almost famous coin, or whatever, and then you're going to pay more than the price of the actual gold or silver in order to purchase it, which means it has to increase in value to come back to even to what you purchased it. Unless, of course, it really is a tradable one that's going to increase in value. But again, if you do sell it, you may have to probably have to pay capital gains. Whereas if you figure out a way to put these HOTS in your Roth IRA or your traditional IRA, then you are going to avoid the cap gains. And in Roth IRAs, then you don't have that income tax at the end too. All right, so I talked already about the 401k and the IRAs, how they work together, and even potentially a health savings account. So Peru is the second largest copper producer in the world. The yield is 4.1% on EPU, is iShares Peruvian fund. It is our small mid-cap value replacement fund. US value funds often pay half the dividend with, I will say there's one country that we use as a value replacement that actually has a higher credit rating than the United States. It has a lot of banks in it, and their banks have higher credit ratings than a lot of the US banks as well. So in the other fund, you're getting a higher yield and you're also getting higher credit quality. I wanted to let everybody know that I'm actually going to be interviewing Rob McEwen. He's the chairman and chief owner of McEwen Mining and McEwen Copper. This is going to be October 29th. And if you'd like to join us live, just email info@nataliepace.com. Also, even if you just want to watch it back on our YouTube channel or Substack podcast, email info@nataliepace.com so that we can make sure you get that information. So, one thing I think we should all be aware of is that the VIX is low, but that can change in a snap. In fact, it changed in April, right? So that was when our Ethereum ETF had dropped to $11 and it was up over $31 yesterday. So it's important to to realize these things, right? And again, if you have an age appropriate, properly diversified strategy, you know that you have kept a lot safe and a percent equal to your age safe. And when you hear that the markets dropped 20%, as they did, April 8th, it was down 20% from the high of February. I believe it was about 19th or 18th. Then you can look and see, wow, is this a buying opportunity? Should I be buying low? Now, the VIX spiked on April 8th, right? Because everybody was freaking out about tariffs. Now people are not as worried about They're like, oh, well, maybe it's not going to pass through an inflation, although we are seeing it, that it has started and the full effects are yet to be felt. But what is really historically low is the consumer sentiment. And that's a concern because if you look at this chart, you can see that when consumer sentiment is low, it has a strong correlation with recessions. Now, there is not a recession predicted for this year or next year, but economists are terrible at predicting recessions. In fact, a lot of times, even when like in as the best example is the Great Recession, right? We were in trouble. We knew we were starting to get into trouble into 2007. We already saw a bunch of mortgage banks failing. We already saw at the beginning of 2008 Bear Stearns need to get bailed out. So there was a lot of trouble, but we kept hearing from the Treasury Secretary and the then Fed Chairman, which was Ben Bernanke, that it wasn't that bad. Don't worry, we're going to fix things. They didn't tell us we were in a recession until the markets had already dropped 35%. That was, and then of course they were begging for money from Congress. So just be aware of that policymakers are really going to try to fix things, but also they don't want to freak people out because that's going to make everybody want to sell their stocks. This is what Liz Ann Saunders said in her May 30th podcast. She said, I feel sometimes like we're in the midst of a late 90s kind of market with the tech bubble, and everything just kept going and going and nothing stopped until, of course, it really stopped. Now, she's a lover of data, so I know she knows this. From the March 2000 high to the October 2002 lows, the NASDAQ fell 78%. It took about 15, 16 years to come back to even. And look here. So our warning came in Christmas of 1999. The recession announcement came in 2001, right after 9/11. But you can see the markets had dropped a significant amount before 9/11 happened. So it's really important to know, look, as we get closer to retirement, we can't afford to have those kind of losses. If you're using our pie chart system, you have a percent equal to your age safe. Let's say you're 50, you're overweighting 20% safe because there is elevated equity prices. There are, the low consumer confidence. There's a lot of measures that show us that there could be trouble ahead on the economic side. It's your choice. You don't have to overweight safe, but let's say you did. You have 70% safe, earning maybe a 4% yield income and 30% at risk. If 30% loses half, that's, much less than if all of your portfolio is. And again, as we get closer to retirement, that's super important. Now, also, if we have diversified and we have value and growth, maybe then our value funds aren't going to sink as far as these growth stocks that are very, very elevated prices, or even some of our HOTS. And one last thing I want to say is that in the beginning of the downturn, crypto, gold, and silver oftentimes gets drugged down with it. Now, there will come a point if people really lose confidence in the economy or in stocks where that decouples and they could go back up. But that's another reason that begs for regular rebalancing, right? So there's nothing wrong with selling high and capturing gains. Again, it's not all or nothing. It's not like you're going to sell everything. You'd still keep, like if you have 4 hot slices and they're 4 different assets, right? And your crypto is the one that, is on fire. You might have 3 slices that you trim back to 1 and you keep the wealth. And that gives you the liquidity to buy low as well. So here's another thing when we talk about stocks being expensive, the only time when stocks were more expensive than they are today was actually the dot-com recession. And we already talked about how much the NASDAQ lost in that time. It took 15 years to crawl back to even. So again, in the beginning of a correction, safe havens typically they will go with stocks and then they will decouple. So this is just from the most recent downturn that I talked about in April. And this is the Silver Trust, SLV. And you can see that silver went down, right? It went way down and then it popped up and it went even higher. So ETHA was just 11 a share and yesterday it was 32. Now, I want you to be aware of Bitcoin halving events because the last 2 crypto winters have come 2 years after the Bitcoin halving event. Doesn't mean that history is going to repeat itself, but it is important for us to understand and know the history. So the most recent halving event was actually in April of 2024. Now, on those other 2 prior halving events, a year later was when it hit its high, and then 2 years later was the crypto winter. So that's another reason why I strongly suggest we think about crypto as hot slices, and when it's at an all-time high, capturing gains and trimming them back, especially as we get closer to this 2-year anniversary in April of 2026. So why is copper called Dr. Copper? Now, what I did here is I'm showing you ECH, and Chile is actually the #1 exporter of copper. Peru is #2. The reason that we don't list Chile as our fund is manyfold. One of them is that their copper mines are actually nationalized. So you're not going to benefit from there, even though the economy is heavily tied up with copper. Also, Chile is a lower GDP expectations. And then thirdly, it has lower income. So those are many reasons why we leaned into Peru rather than Chile. However, I wanted to show you this chart because the Peruvian chart doesn't go back that far. So in the Great Recession, the Chilean fund went down first, but as you can see from the bottom here in November of 2008, so the bottom in stocks was March of 2009. This is 2008. It was at $30 and it went all the way up to $80. And that happened really fast. Like that happened within about a year, certainly less than 18 months. Stocks didn't come close. I mean, they didn't recover for 5 years. So that's what I mean to say is that in the beginning, things can really get drugged down. And copper is definitely called Dr. Copper because it usually hits its bottom before stocks do. But when we start seeing evidence that the economy is going to start rebuilding itself, copper is one of the tools that's needed. And so it really can be, game on blazing. Another argument for rebalancing. So this is what a pie chart looks like if you're 30. Now, in our sample pie chart, we're overweighting 20% safe. You can do that or not. We divide the at-risk side by 10. So small, medium, large, value and growth, your six size and style diversification, and then 4 hots. Now, I list hot because that is where you get to be the person that makes the choice, right? We're on the education side. We want to empower you with the information that you need to be the boss of your money. So if you are worried about the economy, then you might be thinking of a safe haven like crypto or gold or silver, or you might even be thinking about something you think will be more buoyant like consumer staples. I do have a blog about energy like oil and gas. They don't do as well in recessions because people will drive less and take fewer vacations. Also, utilities now have exposure to lawsuits from, people saying, oh, they were responsible for the natural disaster in my area, or, the wildfires or whatever. So I do have blogs on both of those. And if you would like the energy or the utilities blog, feel free to email info@nataliepace.com and we're happy to send that to you. And this is what it looks like if you're 50. And again, overweighting 20% safe in our sample, but you get to be the boss of your money and decide. I already told you why we picked Peru instead of Chile. Will copper prices go higher? Now, the forecast is that even though there may be a weakening of demand, and not to zero, but a slight weakening of demand, that the supply is constrained. And so the forecast is that prices are actually going to continue to go up, not exponentially, but continue strength and actually get higher. However, as we said, if there is a recession, then that could change the game dramatically. That's why it's called Dr. Copper. So one individual company that I had featured a few months ago when I talked about silver and gold was Silver Majestic. It's up 121% year to date. It has massive year-over-year revenue growth, but it's higher risk for higher gain. Anytime you are investing in an individual company, I call it Vegas money, right? For most Main Street investors, unless you want to babysit that stock and really start understanding the analytical tools that hedge funds use, it's probably not a good idea for you to invest in an individual company. Unless you consider it to be Vegas money. But again, sometimes individual investors are not very disciplined about capturing gains. And of course, a lot of times we're tempted to buy high, hoping to sell higher. So just be aware of that. So this is one, and I liked it also that in addition to having a strong forward outlook and higher year-over-year revenue growth, that it also has its own mint. So it is minting silver coins and selling them, and it's being pretty smart about it too. It's minting coins with things on there that different kinds of investors would like. The one that I used as an example is, the Chinese New Year, the dragon, but they also have ones for political purposes and other things that certain people are going to get excited about. So again, value funds, target date retirement funds, and bond funds. Are you paying thousands annually to lose money? So a lot of managed accounts are paying, 1%, some of them even 2%, in order to have your account managed. And I do a lot of second opinions, and I'm seeing, especially if you're conservative or fixed income, they might tell you you're earning 5 to 7% income, but they're not adding in the fees you're being charged or the paper losses. And on the brokerage statement, it will show that as well. You just have to look in a different spot. And a lot of people who are being told that they're earning 5 to 7% income are not being told that their actual total return is sometimes negative, but it could be 2%. So it's super important right now because stocks are at an all-time high, but there's actually elevated risk in the bond market. Bonds lost more than stocks did in 2022. They lost, gosh, what was it, like 26%? And that was a year when stocks lost 20%. Last year, they lost more value. They're very illiquid. So if you buy a long-term stock bond, there may not be another buyer on the other side of the table. And I've seen people sold into 85-year junk bonds that lose value the minute they're purchased in those value in those managed accounts. So I just say it's time to be the boss of your money, to know what you own and why. Now, how could you do that? Well, the one of the easiest ways would to attend our retreat. We're having one in October. It's 3 days, and we spend one full day on what's safe. If you would like to know now, it's October 11th through 13th. It's online. There's no travel involved at all. And we record it, so you can also watch it back as well. I'm then hosting a fixed income without our fixed income strategy, no paper losses. So I'm hosting a masterclass on that October 18th, which is the Saturday after the retreat. So, email info@nataliepace.com if you'd like that. I also do unbiased second opinions in my private coaching. And the reason is I don't manage money. I'm going to look at your plan. I'm going to tell you exactly what you own. I'll show you what a pie chart of a better plan might look like, tell you how you can easily make the changes if you so desire, so that you can be the boss of your money. Because when you're not fully informed, you kind of have to just do whatever you're being told. And it's better when stocks are high but elevated and bonds are illiquid and losing money, to know what you own and why. So value date target funds, target date retirement funds actually are way down on the 5-year. And obviously all of those things are not coming close to the returns of the S&P 500. So paper losses can become real and substantial. No paper losses on our fixed income strategies. And I want to say this, like a lot of people say, well, I'll just hold it to term. Okay, have you looked at the term of some of your bonds? Because the ones that are really losing value are long-term bonds. That means they might be even 30 to 50. I saw one that was 85 years. Are you going to live that long, right? So don't just rely on that's kind of something that's said to placate you. Many older companies are the ones carrying the high debt with the lower credit quality. Over half of the S&P 500 is at or near junk bond status. That includes a lot of energy companies, banks, and many companies founded over 50 years ago, last century. The higher the dividend, the higher the risk, and the more likely that you may suffer from paper losses and illiquidity, which means you won't be able to get rid of it. Certainly not without a loss. So again, which countries will be hot in 2025? And we are using that both for country diversification, which I'm seeing a lot of high, profile analysts talk about country diversification these days. We've been doing it for a number of years. And in Australia, you can get a higher yield, better credit quality, and we're using it as our large cap value fund replacement. So again, you can get safe, hot, and protected in one easy plan. It's easy as a pie chart. You just need to set it up and then rebalance it once, twice, or 3 times a year. And again, we can help you do that, help you learn how to do that in the books, the retreats, or private coaching. And then the goal is to get you completely autonomous. Of course, you can have someone manage your money, but you want to know exactly what you own and how it fits in. And most managed accounts, even if you have 18 pages of holdings and they tell you they're using modern portfolio theory and that you're diversified, when I look at it, a lot of times it's the same kind of thing over and over again, either large cap value or large cap growth and large cap value and a bunch of bonds. You might have a smattering of small caps, but you certainly aren't going to have hot slices. Or if you do, maybe it's in some of the areas that are not going to be that hot. So again, here's our retreat information. Email info@nataliepace.com if you're interested you can also find pricing and additional information. It's going to be 8 to 4 Pacific. That's 11 to 7 Eastern online. So you can attend from your living room and you'll get recordings of it. So I want to just say one last thing, and hopefully we'll have enough time for at least one question. If you haven't invested in any of these hot areas, like these safe havens that are outperforming the Magnificent Seven, but honestly, if you're a conservative investor, you may not be invested in the Magnificent Seven either. If you want to start investing in it, First of all, mock up that pie chart. You can personalize your own pie chart. I have a free web app, info@nataliepace.com to get that. And mock that up first, and then figure out that will tell you, okay, you should have 10,000 per slice. Dollar cost average into it instead of just buying high. Don't wait for the crash or just slam it in there, buying high to fill up the slice. So the right answer would be to dollar cost average and take a year to two to do that. 1 to 3 times a year rebalancing is very important, and now is a great time when stocks are at an all-time high. So again, email info@nataliepace.com. You can personalize your own sample pie chart with our free web app. We have an investor IQ test, a rebalancing IQ test, that's all free. And you can also get additional information on my unbiased second opinion, or of course, the masterclass or the retreat. And just real quickly, I do have a blog on this exact presentation. So if you go to nataliepace.com/blog, you'll see it, or email info@nataliepace.com, and we're happy to send it to you. I know I only have 1 minute left, but is there a question that I can answer?
Yes, thank you, Natalie. We do have at least one question here. If you had to give just one piece of advice to a young investor starting today, what would that be?
Oh man. Well, first of all, assuming you have a job, I would say start up that Roth IRA. The second thing I would say is that a lot of people say, oh, my employer offers healthcare, right? But what they're not understanding is that most employers do offer healthcare, but they pay a portion of it, but they take the other piece out of your W-2. So if you're not looking to see how much you're actually paying for your healthcare, so the health savings account is a game changer for a lot of, but yeah, anybody under the age of 65, because once you hit 65, you can't do it anymore. You could save thousands, if not tens of thousands for some people, annually on healthcare premiums. You get a tax credit, so you pay less to the tax man. And again, you start building up your own wealth, and you can even invest in your health savings account. So I would say that if the most important thing is don't just put everything in your employer sponsored plan, because you can't get hot in there, and it's harder to do your rebalancing there too.
Okay, thank you for that, Nelly. And one last question. With these big headline gains, how can retail investors avoid chasing performance and over allocating into hot assets?
Yeah, so the pie chart system is great. So simply email info@nataliepace.com. There's actually a link right on our website at nataliepace.com, and it's a free web app. And you basically put in how much you got, and it'll show you a pie chart of what you should have. It's going to automatically overweight 20% safe because that's what we're doing in our samples, but you can actually change that toggle too. And that's going to tell you. But the general rule is keep a percent equal to your age safe. Overweight safe if you think it's that stocks are pretty high and there's reasons why they could go down. And then diversify the at risk. I say 10 funds because 10 funds is more diversified than 18 pages of holdings. And then when you see one slice become 4 slices, sell high, capture gains, trim it back to where it should be. If you haven't got any of these hot slices and you would like them, as I mentioned, dollar cost average. Don't wait and say, I'll wait for the crash, because that never comes. Like in April, did you feel like buying Ethereum at that $11 price? Now it's at 32. Now you want to buy it because you see how much gains it's made. So the pie chart system takes the emotions out of it, and it actually helps to put you on the right side of the trade.
All right, perfect. And as always, we love to have you here at the show, Natalie. And thank you to our attendees. And I hope everyone enjoyed the presentation.
Thank you so much.
Thank you.